Today, folks, the end-all, be-all of investing. For moi, for me, I answered some of your questions over the weekend. I had a lot of cool comments on a bunch of my videos that I wanted to kind of highlight in this video today. Everything from retirement, my investing style, and kind of my plans moving forward. That is a conversation you'd appreciate. As always, hit that like button because I love talking stocks, baby. And first and foremost, this was probably one of the more intriguing comments I'd have to say is like, you're pipe dreaming if you think you're going to retire in your 40s, bro. I mean, you've done okay for yourself, but your portfolio isn't that big, and you certainly are not big enough to retire in your 40s. So get real, dude. I offered some insight onto our plans, our thinkings behind this, and someone pointed out that you should do a video showing people how it's possible to retire in your 40s because there's too many haters out there. And I don't think people are haters. It's just a matter of like how many people have actually sat down and made a plan and understand like I'm not like fantasizing this. This is something that requires planning, due diligence, and hard work. And it really just refines down to a compound calculator. And I'll kind of break this down in a simple format because obviously we have to pay off our biggest expense first and foremost, which is the mortgage. That's going to greatly reduce our cost of living, and our mortgage to pay it off in about 9 years because we want to do it by the time we're 40, we're 31. We'd have to put about $20,000 away in principal each year, excluding what we're paying already, right? I just worked it out that $20,000 has to get paid down, which works out to being about $1,700 a month in payments to the mortgage. And taking a look at from the retirement front, because we want our cost of living to be covered by our investments using a basic compound calculator, let's presume that me and my wife, my fiance, that we're working on, we currently have, maybe this isn't accurate, I'd have to really run the math again on all the accounts, but say 220, just ballparking here, excluding, cash, all these other positions that we have in play here, but just 220,000. Let's just say, actually, let's just reduce it even farther. Let's say we have 200,000. Let's really refine this down to base numbers. So 200,000 is what me and my fiance have. Annual additions, well, we presume we're going to also have to put an extra 20,000 away in investments. So that works out to being about maybe 700-800, but each of us off a monthly check, right? So we're each putting away about $1,600 between us, or about $20,000 a year extra in investments on top of paying the mortgage down. So between me and my fiance, who both have full-time jobs, between us we make six figures a year. If we're able to put at least 40,000 of that away, 20 toward the mortgage, 20 toward investments, over a 9-year period, we should be left off with an annual interest rate, if we get market average returns over the next decade, about 770 to 800,000. If I'm even able to make 5% off of that, I mean, you do the math, simple math, 5, 10, 15, 20, 25, 30, 35, 40,000 a year before taxes. I mean, we wouldn't need more than 25 to 30,000 if we have no other expenses in our life. But this is obviously variable to so many extents. We don't own a house. We own a comfortable condo, 2-bed, 2-bath. If we want to have kids, if we decide to have kids and the kid gets older, we can't really comfortably live here. Yeah, we'd have to scale up, maybe move to Alberta. I mean, there's so many variables that come over a 9-year period being in your 30s that this is going to change over time. But presuming nothing changed, everything stayed as it is now, within 9 years, we would comfortably be able to retire off a 700-800K portfolio, doing this exact math showing you here. And all of you can do this. You just have to find growth vehicles that offer 10%. Let's presume the market does better. The S&P's offered higher than above average returns, though people are expecting it to be lower than average returns over the next decade. Nobody really knows. That's why we diversify in assets that tend to offer higher than 10% return. S&P's been like, 11, 12. SCHD, the dividend ETF, has been 11 or 12%. There's a lot of good vehicles out there, right? There's no guarantee in any of this. All of this could change tomorrow. Who the heck knows? Nobody knows what's going on. One of us could lose our job too, right? But moving on, personally, I think you should diversify more to the investing world than just Canada and the S&P 500. How about gold miners, healthcare, international, emerging markets? So I am diversified. Like, again, we own crypto, we own precious metals. I own some small cap investments, private placements, but primarily most of our money is in the Canada and the US, and I like it that way. Apple is a globally diversified company. Pepsi sells globally. These are the world-renowned companies. This is where tech innovation lives. This is where government, hasn't stifled tech innovation yet like it has been in China and a lot of these other emerging markets. I see more growth going on in, say, Africa, some of the Latin American countries, maybe like, Colombia or like Peru. They're getting some good GDP growth, but I mean, I'm more comfortable investing in Canada. I understand the tax regulations, the government a little better, the U.S. for growth, and honestly, diversification at some point I think gets redundant and ends up costing return. Because let's be real, are you diversified in your business? Probably not. You probably work for one company. At any point in time, you could get laid off. And I'm not saying to use that as an excuse to under diversify a portfolio, but just for me, I think I'm getting enough diversity between owning Canadian and U.S. assets primarily, with again some more speculative and other investments like precious metals in the physical form. Do you listen to any macro experts? You mentioned a few here, or is it all noise and just invest blindly and be super hyped with the market going up, up and away forever and ever? Yeah, it depends on what you want to do. I listen to macro investors all the time. I listen to tons, Tom Lee, tons of bears, Peter Schiff. I still listen to. I listen to everyone's opinion. I think it's just entertainment value. I think that anyone predicting what's going on tomorrow in the market, if they're not a billionaire and they haven't been a billionaire in the past, clearly they're not very good at predicting the market. I look at Michael Burry. I mean, I don't even think that guy can replicate what he did in 2008. There was a lot of blind luck that comes into play when you're predicting the future. It's thusly the idea of gambling, but you're trying to get the odds in your favor by understanding a few things with no guarantee. Honestly, most people should just be blindly investing in the broader markets. You don't have to worry about it. There's no stress. Over a 20-year period, you would have never lost money. That's why it's just easy to blindly invest, right? It's just a matter of doing it is the hard thing for, I think, most people. After having gotten burned on some single company stocks this past year, in particular renewable energies like Algonquin Power, Northland Power, I've switched my style to only buying ETFs such as VDY, VSP, VOO, and SCHD. Might also buy QQQ, but definitely not into single stocks anymore. I am too old for that now. I'm in my mid to late 40s. That being said, for younger people, I think single stock risk is worth it. I have huge capital gains from big tech companies that I bought 7+ years ago. And this is the endless debate that I keep telling people that I think when you're in your early 20s, your time horizon is so long you can overpay for companies and let the valuations catch up and hope to get extended returns beyond market average. I know a lot of people say, oh yeah, but if you risk it and lose it, you gave up all that early day of return that you could have just got buying a broader index. And you could do a bit of both. But honestly, I can only talk about my circumstance, and this why it's called personal investing. I had absolutely just absolutely unproportionately sized gains and returns. Like, I have outperformed on a percentage basis every finance YouTuber that I know. And I'm not saying that to brag. It was just during one of the greatest decades of growth in the market history. It was from not overplaying the market, and it was from buying large tech companies and just holding them for several years and speculating on some small caps and taking profits all the way up. I didn't hold them through the implosion of 2021 into 2022, right? I've been very mitigated, and it worked to my favor. And I'm saying that I did that through my 20s. So why would I say, oh, only buy indexes in your 20s when, I set myself in a position to be able to afford real estate, start my life, and do all this stuff from individual stock investing, even though now I'm proponently more inclined to do ETF investing, right? And again, that's just as things change. Like him, when you get older, you get in your 40s, you build more wealth, you tend to like security over volatility, right? And personal finance, different for everyone. Kyle, VEQT is combined of VUN, VCN, VIU, and VE. So we're talking about this ETF on the live stream, which is this really awesomely diversified that gives you like some of the best stocks that I love, and its performance is pretty reasonable. I mean, since inception here, we'll take a look at the 5-year performance. It would have returned about an extra $5,100. So you'd be up 50 points, right? Which is pretty good. When we look at the holdings in this ETF, it's basically giving you like an end-all be-all buy for people that just don't want to diversify or have to buy like 5 different ETFs, because it holds Apple, Microsoft, Royal Bank, Toronto Dominion Bank, Amazon, Shopify, Nvidia, Canadian Pacific, Kansas Railways, Enbridge, Canadian National Railway. It's like the perfect emergence of all the Canadian and U.S. stocks, which is really fascinating to me. The yield is, it's reasonable here. I mean, 1.86%. It's falling more in line with the S&P, a little higher actually. And this could be a great thing to buy, other than you're kind of losing it to the management fee here. But 0.2 is not that bad either, right? But this is an interesting ETF, right? So I wanted to kind of extrapolate on this, because its question is, why untake VCE or VCN? Good show, by the way, so I appreciate the comment. But the reason I do like VCE, I think XIU, like some of these more global Canadian market, not global, but Canadian focused ETFs that are like the broader Canadian markets, like this one here. The yields are pretty nice. The returns, however, I've noticed that the concentration into Canadian stocks tends to give you better performance. So here's a broad ETF. Again, the 5-year performance would have returned you right around 14,300. Here's VCE, one of the main Canadian indexes I like a lot. Extremely low management fees, 3.3% yield, super awesome. But when we take a look at the return, again, you're looking at about 14,700. So you're not talking about the same kind of return that you're getting out of this all equity ETF, but very similar performance, but where the outperformance comes into play seems to be in the Canadian dividend market, because most of Canada's large cap companies are dividend payers. This thing's yielding 4.7%. After the management fee, it's 4.5%, so it's over, a point and a half higher, and it pays monthly, by the way, over these other ETFs that pay quarterly. And when we look at the return over the last 5 years and comparable, your return would be sitting around 15,000. So it falls very closely in line with VEQT on the return standpoint. Again, and it's funny because you're paying roughly the same management fee. Actually, I think you're paying a less of a management fee, so your return is probably, almost exactly in line. But it really kind of goes to show you that in the Canadian markets, if you just focus on the concentrated Canadian dividend payers, which obviously VDY is basically all the major Canadian companies, Royal Bank, Toronto Dominion, Enbridge, Canadian. And nothing says the past is going to represent the future. I think there's a lot of potential in some of these Canadian tech companies like Shopify that aren't listed in here. So just kind of getting the diversity is probably the better option. And this is just the all, this VEQT thing is really fascinating because it could be an end all be all. Because I'm basically buying VOO. I'm buying the Canadian banks. I'll probably buy VCE or VDY, and buying all that stuff, I could just get it basically out of this one ETF, which is a very fascinating way of thinking about investing, in my opinion, if you want to simplify things. But TD, CIBC, Scotia, which one is the most safest bank? You can make a video based on that. If I had to bet between the three, TD's safer because of its market cap. Scotia's probably pretty safe because of the global diversification to some extent. However, the safest bank is obviously Royal Bank. It's highly concentrated. The Canadian economy, it's highly regulated. It's Canada's largest company. It's basically too big to fail at this point. Yeah, its performance isn't nearly the same. I think TD has outperformed Royal Bank over the long term. I'd have to double check, but still, Royal Bank I think is the safest just because the market cap is like JP Morgan, right? Like, what's the safest bank in the US? The largest bank, JP Morgan. Look at National Bank. If you want performance, this is a much smaller cap, but has outperformed all the banks basically. So this has been one of the best growth banks you could have held over the last 20 years. Heck, even since 2011, 2012, you're up 231%. Very in line with something like the S&P 500 returns, with the dividend sitting at 4.3%. Pretty astounding stuff. Moving on, you still haven't made a video on HMAX. Do you think it's worth getting HMAX at these prices? I debate this a lot with people. I'm just not interested in making videos on them because I don't like covered call ETFs. I never have. I know they're good for perhaps retirees, people that want more cash flow, but for most people, it's probably taxed inefficiently if it's not in a tax advantaged account. I mean, they all tend to underperform the markets over long periods of time. I mean, you can go into Hamilton here and just take a look. Most of these haven't even been around for 3 years yet, and it's hard to judge an investment without like at least a 10 to 20 year time history. I mean, you can't look at something and within 1 or 2 years being like, oh, that's genius, that's going to work. I mean, this is all I need, right? It's like the TSLY, like everyone loves it, but its outperformance and its oversized dividends doesn't make any sense because if that was a possible, like I think they're offering like what, a 50% yield or something ridiculous. I could be wrong. I'd have to double check, but it's unsustainable, right? And a lot of these covered calls have, they just degrade over time. And I can give you an example with probably one of the best, most world-renowned dividend or covered call ETFs being like the Global X Nasdaq 100 QYLD. And this thing from a chart perspective, you're like, oh, this is garbage. It's down 30%, but you're buying this for the yield, right? And if we take a look at the actual return, total return, and I imagine this is including dividends invested, you're at around 94%, right? So this isn't like you spending the dividends. I don't even know if that would be dividends reinvested or not. I actually have to double check. But still, 94% versus the index, which is up 110%. So it's pretty much in line. You would have made 15% more buying the index over, QYLD. But again, very similar performance, right? Because it's all getting paid out in the yield. However, still underperform the markets, and I find the vast, almost every single one of these underperform over long periods of time. I've yet to find one over a 10-year period that has outperformed the S&P 500, right? So if I want yield, what I also want is dividend growth, right? So let's take a look at QYLD and see what the dividend's done on Seeking Alpha, for example. If we just take a look here, just to see the dividend history, I'm very curious because I also want dividend growth, the performance of dividends over time. Like, look at this. So, 10 years ago, you were getting 26 cents a share. Today, you're getting 17 cents. So you haven't even gotten dividend growth, right? So, why cap into a 10% yield where if you have a 20 or 30 year time horizon, you could buy a bank stock that's yielding 4%. It tends to double the dividend every decade. In the next 20 years, that 4 becomes 8. That 8 could easily become, well over 10% by the time you're retired, and it's only going to go up over time. So you're matching inflation. so your payments and your cash flow can help keep up with inflation as companies grow and pay dividends. This does not keep up with inflation over time, right? I mean, it's great that the yield is so high and it's been able to match market returns, but that eventually is going to degrade against the average market return because there's no dividend increases. So that's just my humble opinion with a lot of this stuff. But finally, I play a lot of VR2 lol mini putt with the boys. So I should do I wish I had it before and after, but I've gotten really in shape playing VR, like really intensive workout games, like Call of Duty like games, doing push-ups in between games. I've been doing that for 2 years now, and I'm kind of shocked at how much my body's transformed. But he's also saying I hope to retire by 40. But I am single, stock picker. I have been in the GTA, Greater Toronto area. I'm about your age. I can relate to your personal story very much, so I appreciate that. And we should hook up on VR and see if you play any of the games like Population One or some of the games that I love playing. We should do another meet and greet. Maybe we should do a VR meet and greet. I'm gonna get the new Quest 3 when that drops. Hopefully soon here in the fall. I really want to get the new VR headset. But nonetheless, I do appreciate all the comments, all the questions. I hope you enjoyed the video today. Let me know what you think.